In the summer of 2019, a company that rented office space was valued at $47 billion, more than Boeing, more than Ford, more than the entire GDP of many countries. Its founder was on the cover of magazines, its offices were in 111 cities, across 29 countries, and Wall Street was preparing to hand it one of the largest checks in stock market history. 6 weeks later, the IPO had collapsed, the founder had been forced out, the company that had been called the future of work was negotiating emergency loans just to make payroll. How does a business that charges companies rent convince the world it is worth $47 billion, and how does that illusion shatter in 6 weeks? The answer begins not with balance sheets or investor decks, but with a man who walked into rooms and made people believe the impossible was inevitable. Adam Neumann was born in Israel in 1979 and spent part of his childhood on a kibbutz, a communal agricultural settlement where resources are shared and individual success is tied to collective well-being. That experience, he later said, shaped everything. When he moved to New York in 2001 with little money and no connections, he carried with him both the genuine idealism of communal living and the salesman's instinct to make that idealism profitable. He tried several businesses before finding his concept. He sold baby clothes with knee pads for crawling infants. He launched a collapsible high heel. Neither went anywhere. Then, in 2010, he and a partner named Miguel McKelvey converted a floor of a Brooklyn building into shared office space for freelancers and small businesses, charged monthly memberships instead of long-term leases, and called it WeWork. The timing was perfect in ways Neumann had not entirely planned. The 2008 financial crisis had decimated the traditional office market. Companies were shrinking their footprints. Freelancers and startups were proliferating. The gig economy was producing a generation of workers who needed professional space without 5-year lease commitments. WeWork offered exactly that, and it dressed the offering in the language of Silicon Valley rather than commercial real estate. Neumann did not call WeWork a real estate company. He called it a technology company, a community company, a company trying to elevate the world's consciousness. He told anyone who would listen that WeWork was not in the business of renting desks. It was in the business of changing how humanity worked, lived, and connected. That reframing was not accidental. In Silicon Valley, technology companies receive much higher valuations than real estate companies because technology scales without proportional cost increases. A software product can reach 1 million users for roughly the same cost as reaching 1,000. Real estate does not scale that way. Every new WeWork location required signing a long-term lease, renovating the space, staffing it, and then filling it with members whose monthly payments covered the cost. It was fundamentally a real estate arbitrage business. Lease low, rent high, pocket the difference, dressed in the vocabulary of a tech startup. And for a remarkably long time, that vocabulary was enough. The person most completely captured by Neumann's vision was Masayoshi Son, the founder and CEO of SoftBank, the Japanese technology investment conglomerate. Son had made his reputation and his fortune by making enormous bets on companies before the rest of the world understood their potential, most famously his $20 million investment in Alibaba in 2000, which eventually became worth over $70 billion. By 2017, Son was running a $100 billion vision fund, the largest private technology investment vehicle in history, and he was under constant pressure to deploy that capital at scale. When he met Neumann in January 2017 for a 12-minute meeting that took place, according to both men's accounts, largely in the back of a car, Son was impressed by something very specific. Not the financial model, not the unit economics, not the occupancy rates. He was impressed by Neumann's craziness, his term used admiringly. Son told Neumann afterward that in a battle between a crazy person and a smart person, the crazy person wins. He then wrote, "WeWork a check for $4 billion. That investment valued WeWork at $20 billion. It also changed the company's behavior in ways that would eventually destroy it. With essentially unlimited capital available, WeWork stopped worrying about profitability and started racing for scale. It signed long-term leases on office buildings in every major city in the world, sometimes committing to decades of rent payments before a single member had walked through the door. It launched WeGrow, a school for children, and WeLive, a co-living residential concept. It bought a wave pool company in New Jersey. It bought a software business. It bought a coding school. None of these acquisitions had any obvious connection to office space, and none of them generated meaningful revenue. But each one reinforced Neumann's narrative that WeWork was not a real estate company, but a diversified technology ecosystem, and that narrative kept the valuation climbing. By early 2019, SoftBank had invested over $10 billion in WeWork across multiple funding rounds, and the company's internal valuation had been pushed to $47 billion. Neumann was worth approximately $4 billion on paper. WeWork was operating in 528 locations across 111 cities. It was also losing money at a rate that was extraordinary even by Silicon Valley standards, $1. $9 billion in 2018 alone on revenue of $1. $8 billion meaning the company was spending nearly $2 for every dollar it brought in. But losses at this scale were not unusual in the technology sector, where companies like Amazon and Uber had famously operated in the red for years before reaching profitability. WeWork's pitch to public investors was the same pitch it had made to private ones. The losses were temporary. The network effects were real, and the eventual profitability, when it came, would justify every dollar spent getting there. The IPO prospectus that WeWork filed with the Securities and Exchange Commission in August 2019 was supposed to be the document that transformed that pitch into public reality. Instead, it became the document that ended everything. But before the prospectus, there was the culture, and the culture was unlike anything corporate America had seen from a company of this size. Neumann ran WeWork like a personal fiefdom wrapped in startup aesthetics. Tequila shots were poured at all hands meetings. A company rule prohibited employees from expensing meat-based meals, a policy reflecting Neumann's personal dietary philosophy, imposed on a 12,000-person global workforce. He surfed in the office. He held meetings barefoot. He once arrived at an important business discussion smelling of marijuana and carrying a cereal box he proceeded to eat from throughout the conversation. Staff described an environment where Neumann's mood dictated the company's strategic direction on any given day, where people who challenged him were sidelined, and where loyalty to the founder mattered more than operational competence. Behind the carefully curated image of community and consciousness raising, WeWork's internal operations were chaotic in ways that directly harmed the business. The company consistently underestimated the cost of building out new locations, signing leases based on projections that assumed rapid occupancy, then discovering that renovation costs and slow member growth meant months of negative cash flow before a location broke even. Its technology systems, the backbone of its claim to be a tech company rather than a real estate operator, were built on a patchwork of acquisitions and internal builds that did not reliably talk to each other. And its human resources department was the subject of multiple lawsuits alleging a culture in which complaints about misconduct were handled by making the complainant disappear rather than the problem. The prospectus, running to hundreds of pages, contained information that private investors had never been shown in such explicit detail. It revealed that WeWork had committed to $47 billion in long-term lease obligations, meaning it owed landlords $47 billion, regardless of whether its spaces were full or its business was growing. It revealed that Neumann had personally trademarked the word "we," and then sold that trademark to his own company for $9 million, a transaction so obviously self-serving that it had to be reversed the day after it became public. It revealed that Neumann had borrowed hundreds of millions of dollars from WeWork at favorable rates, using company stock as collateral. It revealed that his wife, Rebecca Neumann, had the contractual right to choose his successor as CEO if he died or became incapacitated. And it introduced a metric called community-adjusted EBITDA, a financial measure that WeWork had invented specifically to make its losses look smaller by excluding costs that virtually every other company in the world included in standard profitability calculations. Analysts who read the document were not merely skeptical, they were alarmed. NYU finance professor Scott Galloway published a widely circulated analysis calling WeWork one of the greatest examples in history of a charismatic founder separating investors from their capital through the power of narrative rather than the quality of a business. Investment banks that had been competing enthusiastically for the mandate to lead the IPO began quietly revising their valuation estimates downward. Where private markets had valued the company at $47 billion, public market analysts were suggesting the real number was somewhere between $10 billion and $20 billion. Some suggested it might be even lower. The IPO was postponed in September 2019. Then it was indefinitely shelved. Within days of the shelving, WeWork's board of directors, the same board that had approved every acquisition, every lease commitment, and every related party transaction Neumann had brought them, concluded that Neumann had to go. He was consuming the company's credibility faster than any PR team could rebuild it, and without a successful IPO, WeWork was going to run out of cash within months. The terms of Neumann's departure were extraordinary. He received a consulting agreement worth $46 million. He was allowed to keep an ownership stake that made him one of WeWork's largest individual shareholders. He received a $500 million credit facility from SoftBank to help him repay loans he had taken using WeWork stock as collateral. And he was given the right to sell up to $1 billion of his personal WeWork shares back to SoftBank. The total value of his exit package was estimated at approximately $7 billion, paid to the man who had driven the company to the edge of collapse. The workers who lost their jobs in the layoffs that followed received far less. With Neumann gone and the IPO abandoned, WeWork needed emergency financing just to continue operating. SoftBank stepped in with a $9.5 billion rescue package in October 2019, a deal that gave it majority control of the company but valued WeWork at just $8 billion, a drop of 83% from the $47 billion peak reached only weeks earlier. Thousands of employees were laid off. The private jet fleet Neumann had assembled was sold. The wave pool company was divested. WeGrow was shut down. The ambitions of building a new kind of civilization through shared workspace were quietly retired. And WeWork was forced to confront the reality it had been avoiding for years. It was a real estate company. It was losing enormous amounts of money, and the path to profitability required cutting costs rather than expanding vision. The years that followed were a slow-motion unraveling. WeWork went public in 2021 through a merger with a special purpose acquisition company, the backdoor stock market listing it had failed to achieve through a conventional IPO at a valuation of approximately $9 billion. That figure continued to fall. By 2023, WeWork's stock had lost more than 98% of its value from its post-SPAC peak. On November 6, 2023, the company filed for Chapter 11 bankruptcy, listing billions of dollars in debt and citing the crushing weight of long-term lease obligations that made profitability impossible at the scale the company was operating. Masayoshi Son, who had invested more than $10 billion in WeWork, wrote down essentially the entire investment. SoftBank's Vision Fund, which had been the largest and most aggressive technology investment vehicle in the world, reported losses so substantial that they damaged SoftBank's reputation and Son's standing as a technology visionary for years. The banks and institutional investors who had lined up to participate in the IPO had lost nothing. They had never actually committed capital, but the secondary investors who had bought WeWork shares after its SPAC listing lost the vast majority of what they had invested. Adam Neumann, who had been forced out in disgrace in 2019, resurfaced in 2022 with a new company called Flow, a residential real estate venture aimed at transforming the rental apartment market through community and technology, a description that sounded, to many observers, remarkably similar to the description WeWork had used for its office business a decade earlier. Flow raised $350 million in funding from the venture capital firm Andreessen Horowitz, which valued it at over $1 billion before it had generated any meaningful revenue. The cycle, it seemed, had not ended. It had simply reset. The WeWork story is not really a story about one man's ego, though ego was certainly present. It is a story about what happens when a financial system rewards narrative over reality for long enough that the distance between the two becomes impossible to close. Masayoshi Son did not invest $10 billion in WeWork because he was foolish. He invested because the system he operated in rewarded speed and scale above all else, because being wrong on a $10 billion bet that worked was better than being right on a $100 million bet that was too cautious. And because Adam Neumann was genuinely extraordinary at making the future sound not just possible, but inevitable. The question the WeWork collapse raises is not whether Adam Neumann was a fraud. Courts and regulators never formally charged him with fraud. The question is whether the system that produced him, that handed him $10 billion based on a 12-minute conversation, that valued his office rental business at more than Boeing, that paid him $1, $7 billion to leave the company he had damaged, has learned anything from what happened. The evidence, given what followed with Flow and with dozens of other richly valued startups built on narrative rather than revenue, suggests it is not. $47 billion, 6 weeks, one prospectus. That is all it took to expose the distance between what Wall Street wanted to believe and what was actually true. The tragedy is not that WeWork failed. Companies fail every day. The tragedy is that by the time the truth was visible to everyone, the people least able to afford the consequences, the employees who lost their jobs, the small investors who bought shares, were the ones paying the price for a story they had never been asked to verify.